Welcome to The Swing, the official newsletter of the Forex Trade Room, July 29th, 2023, Volume 23. On Friday, July 28th, 2023, the dollar index fell below 102 because inflation in June showed signs of cooling. Core PCE prices rose by 4.1%, the slowest since September 2021, and below expectations. However, the dollar index is still on a winning streak for the second straight week, backed by strong U.S. economic data. The U.S. economy expanded by 2.4% in the second quarter, beating expectations, with durable goods orders surging and jobless claims hitting multi-month lows. Meanwhile, the euro and the sterling rebounded from their lows, but the yen slipped to $139.80 after the Bank of Japan kept its ultra-low interest rates policy, but made its yield curve control policy more flexible. Right now, it's an exciting market with lots of ups and downs. The Australian dollar, weakest levels in over 2 weeks. The Australian dollar took a bit of a hit, depreciating below 67 cents and hitting its weakest levels in over 2 weeks. Pressure from U.S. economic data. The heat is on. Stronger than expected U.S. economic data is adding pressure on the Aussie, pushing it to fight harder. Federal Reserve tightening. The U.S. data supporting the case for the Federal Reserve to tighten its policy further. It's like facing a formidable opponent that keeps getting stronger. Fall against the yen. The Aussie fell sharply against the yen as the Bank of Japan shook things up with flexible yield curve control. Spectators are speculating on further policy changes. Surprise decline in retail sales? On the home turf, surprise, surprise, Australian retail sales unexpectedly declined in June. But remember, surprises keep things exciting. Producer inflation slowed. In Q2, producer inflation slowed to its lowest in over 2 years. Talk about twists and turns. Consumer price index. Surprise. In the second quarter, the country's consumer price index rose less than expected. Expect the unexpected, right? Reduced pressure on Reserve Bank of Australia. All this action means reduced pressure on the Reserve Bank of Australia. They paused their rate increases earlier in July to assess the impact of previous moves on the economy. The Canadian dollar. The loonie has been putting up a fierce fight, but there have been some twists and turns in the game, weakening past 1.32 per USD. The Canadian dollar has been skating on thin ice, weakening past 1.32 against the USD. It's been quite a battle. From 10-month high to slow down. Just when we thought the loonie was soaring high with a 10-month high of 1.31 on July 13th, new CPI data brought it back down to earth. It pointed to a marked slowdown in Canadian inflation. Talk about a roller coaster ride. Consumer prices rise, but below expectations. In June, consumer prices rose by 2.8% from the previous year. It's still impressive, but it fell below market expectations of 3%. Trimmed mean core inflation rate, measured closely by the Bank of Canada, it remains strong at 3.7%, beating market forecasts. Could this mean another rate hike? Central bank action. The Bank of Canada delivered as expected in its last meeting. They scored another 25 BPS increase in their target rate, and they're determined to restore price stability. Oil prices retreat. The loonie faced some pressure as oil prices took a slight retreat since mid-July. The Japanese yen. Yen holds strong, near 139 per dollar. The Japanese yen is standing its ground, holding near 139 per dollar. It's putting up a strong defense. Trading range, 141 to 138. The yen has been moving all over the charts, trading in a wide range between 141 to 138. Ultra-low interest rates, flexible policy. The Bank of Japan is calling the shots, maintaining its ultra-low interest rates, but making its yield curve control policy more flexible. A tactical play. Short-term interest rate target, minus 0.1%, 10-year bond yield, 0%. The BOJ is staying focused, keeping its short-term interest rate target at minus 0.1%, and the 10-year government bond yield around 0% during the July meeting. Yield movement as references. Here's the surprise move. The central bank allows the 10-year yield to move 0.5% in either direction, but they're calling it references rather than rigid limits. A new game plan. First surprise move under Governor Ueda. Governor Kazuo Ueda has made his mark with this first surprise move. It's shaking things up and likely spurring bets on further policy changes. Speculations on policy normalization. The markets have been buzzing with speculations. They've been anticipating that Japan's last major central bank holding a dovish position might finally make a move. Persistent inflation and rising global interest rates have been putting constant pressure on Japan's bond yields and currency. The stakes are high. The New Zealand dollar, NZD falls 0.3%, weakening for the third straight session. The New Zealand dollar is feeling the heat, falling 0.3% to around $0.6156 on Friday. That's the third straight session of weakening. Can it make a comeback? US dollar strengthens. The US dollar is flexing its muscles, getting stronger with the index standing above 101. And it's all thanks to solid US Q2 GDP data. Headline inflation eases to 6% in Q2 2023. The headline inflation in New Zealand eased to 6% in Q2 2023. That's the lowest since Q4 2021, staying outside the central bank's target range. The Kiwi is putting on a tough fight, but it stays outside the central bank's target range of 1 to 3%. It's determined to bring inflation back into range. Borrowing costs raised, total of 525 BPs to 5.5%. The RBNZ has raised borrowing costs since October 2021 by a total of 525 BPs, now at 5.5%. Weak consumer confidence in July. The Kiwi is facing some challenges on the home turf. Consumer confidence in New Zealand remained weak in July, feeling the pressures from the cost of living and rising inflation expectations. Vigilant traders await economic data. Traders are keeping a close eye on New Zealand's upcoming economic data next week. Business confidence, building permits, and the Q2 jobless rate are all in the mix. It's going to be exciting to watch it all play out. The Swiss franc at 0.86 per USD. The Swiss franc is showing its strength, currently valued at 0.86 per USD. It's putting up a strong performance. Below 8-year high, the franc is just shy of the 8-year high of 0.857 touched on July 18th. Tight U.S. labor market lifts the greenback. The competition is heating up. Renewed evidence of a tight U.S. labor market is lifting the greenback, but the Swiss franc is holding its ground, over 3% stronger. Since Q3, the Swiss franc is proving its strength, remaining over 3% stronger than the US dollar since the start of the third quarter. Signals of rate hiking cycle. Persistent signals indicate that the Swiss National Bank, SNB, will keep its rate hiking cycle in September. They're on top of their game, guarding against upside inflation risks from second-round effects. Relatively low inflation rate. The Swiss franc isn't backing down. Despite a relatively low inflation rate of 1.7% in June, they're determined to stay ahead of inflation. 250 basis point rate increase. The SNB has made bold moves, raising its main rate by a whopping 250 basis points since the start of its tightening cycle. They're taking on elevated inflation like true warriors. Shedding foreign exchange reserves. The central bank is showing its strength by shedding a considerable amount of its foreign exchange reserves. That's how they're supporting the franc and limiting inflation on energy products that Switzerland imports. The British pound weakens below $1.28. The British pound is facing some tough competition, weakening below $1.28. It's putting up a valiant effort, but can it make a comeback? Lowest level since July 6th. It's been quite a challenge. The pound has reached its lowest level since July 6th, but don't count it out just yet. Investors shift towards the greenback. The game took a turn when investors shifted towards the greenback. Stronger than expected second quarter GDP data from the US got their attention. It's a fierce battle. Weaker PMI and inflationary pressures. On the home turf, the UK is facing its own challenges. Weaker than expected PMI data and reduced inflationary pressures are keeping the Bank of England on its toes. Will they raise rates as aggressively as expected? Interest rates on the rise. The Bank of England is gearing up. They're expected to raise interest rates by another 25 basis points at the August meeting. Anticipated peak at 5.75% in November. Investors now expect interest rates to peak at 5.75% in November, a change from earlier projections. The euro. Euro tumbles to $1.10. The euro is in the spotlight, tumbling to $1.10. It's hitting its weakest level since July 6th. Can it bounce back? ECB nearing the end of tightening cycle. Investors think the European Central Bank is nearing the end of its tightening cycle. The game may be changing. Borrowing costs at multi-year highs. The ECB raised interest rates for a ninth consecutive time, bringing borrowing costs to fresh multi-year highs. A pause in rate hikes. President Lagarde hinted at a possible pause in rate hikes during the September meeting, when new inflation forecasts will be released. The ECB's strategy is evolving. GDP and CPI data digestion. Investors are digesting key GDP and CPI data from across Europe. Spain and France are showing sustained growth in Q2, while the German economy seems to be stagnating. Mixed inflation rates. Inflation rates in Germany and France slowed in July, while Spain's rate unexpectedly rose. The euro is still feeling the pressure. The Fed's moves. The Fed hiked rates by 25 bps and made some interesting remarks about a soft landing for the economy. The game is heating up on both sides of the Atlantic. WTI crude oil. WTI crude eases below $80 per barrel. The WTI crude futures have taken a bit of a dip, slipping below $80 per barrel on Friday, fifth consecutive week of gains. Crude is still on track for its fifth straight week of gains. Tightening global supplies and Chinese demand. What's driving crude oil gains? Well, there are signs of tightening global supplies and a surging outlook for Chinese demand. A dynamic duo indeed. 13% rally. This month, WTI crude oil has already rallied about 13% this month. Voluntary output cuts. Possible game changer? Saudi Arabia and Russia are executing voluntary output cuts. You better believe that's expected to tighten crude supply. OPEC Plus teamwork. OPEC Plus is showing their team spirit. They're ready to take further action to support the oil market. Teamwork makes the dream work. International demand. On the demand side, Chinese authorities are stepping up to the plate, pledging to boost their slowing economy. That's raising hopes for a grand slam in fuel consumption. Inflation woes. Here's the curveball. The U.S. Federal Reserve and the European Central Bank have raised interest rates in July, tackling stubborn inflation. But this move has sparked fears of weaker long-term demand and affected market sentiment. Gold. Gold holding. Below $1,960 an ounce. Gold is holding its ground below $1,960 an ounce. Gold is facing renewed pressure from stronger than expected U.S. economic data. The Federal Reserve is eyeing further tightening, and that's affecting the game. U.S. economy expanding. The U.S. economy is on fire. It expanded by a whopping 2.4% in the second quarter of 2023, leaving market expectations in the dust. Soaring durable goods orders. U.S. durable goods orders are soaring past expectations in June. Talk about a power move. Jobless claims plummet. The U.S. jobless claims are taking a dive, plunging to multi-month lows last week. The economy is on a roll. Fed and ECB rate hikes. The central banks are making their moves. The Fed implemented a 25 basis point rate hike, and Fed Chair Jerome Powell is keeping the door open for more increases. Meanwhile, the European Central Bank also delivered a quarter-point rate hike. Bank of Japan stays the course. The Bank of Japan maintained its ultra-easy monetary policy. It's holding strong, playing its own game.
The Swing Focus, Mastering Risk Management for Trading Success. Greetings, Inner Circle members. In this edition of the Swing newsletter, we shine the spotlight on the crucial aspect of risk management in the Forex market. Strap in as we explore the key points to help you navigate the exciting world of currency trading while safeguarding your hard-earned capital. Why risk management matters. Trading the Forex market can be exhilarating, but it's essential to remember that it comes with its fair share of risks. Effective risk management is like having a safety net. It protects your trading account from potential losses and ensures sustainable growth over time. Protecting your capital. Never forget the golden rule. Never risk more than you can afford to lose. Start with a well-defined risk tolerance that suits your financial situation and stick to it. Employ position sizing techniques to control the amount of capital you put at risk in each trade. This helps minimize the impact of losses on your account balance. Setting stop losses. Think of stop losses as your guardian angels. They automatically close your trades if the market moves against you, preventing catastrophic losses. Use technical analysis and support resistance levels to place stop losses strategically, allowing for market fluctuations without exposing your account to excessive risk. Diversification and correlation. Avoid putting all your eggs in one basket. Diversify your trades across different currency pairs and asset classes. Be aware of correlations between currency pairs. Correlated pairs move in tandem, so diversification is vital to avoid doubling your exposure. Mindset and emotional control. Keeping your emotions in check is a vital part of risk management. Fear and greed can cloud your judgment, leading to impulsive decisions. Stick to your trading plan and remember that losses are a natural part of trading. Stay disciplined and focused on your long-term goals. Periodic review and adaptation. Risk management is an evolving process. Regularly review your trading strategy and risk management rules to ensure they align with your current market conditions and goals. Learn from your trading experiences, both successes and setbacks, and be open to adapting your approach accordingly. Conclusion. In the fast-paced world of Forex trading, risk management is your strongest ally. By protecting your capital, setting stop losses, diversifying your trades, and maintaining emotional control, you can enhance your chances of long-term trading success. Remember, Forex trading is a marathon, not a sprint. Stay disciplined, manage your risk wisely, and may the pips be ever in your favor. Happy trading, the Forex Trade Room. The Art of Currency Trading by Brent Donnelly. Now you can master the art of foreign exchange trading. While most currency trading and foreign exchange books focus on international finance theory or simplistic chart-based strategies, the Art of Currency Trading is a comprehensive guide that will teach you how to profitably trade currencies in the real world. Author Brent Donnelly has been a successful interbank FX trader for more than 20 years, and in this book, he shares the specific strategies and tactics he has used to profit in the Forex marketplace. The book helps investors understand and master foreign exchange trading in order to achieve sustainable long-term financial success. The book builds in intensity and depth one topic at a time, starting with the basics and moving on to intermediate then advanced setups and strategies. Whether you are new to currency trading or have years of experience, the Art of Currency Trading provides the information you need to learn to trade like an expert. This much-needed guide provides an insider's view of what drives currency price movements, a clear explanation of how to combine macro fundamentals, technical analysis, behavioral finance, and diligent risk management to trade successfully. Specific techniques and setups you can use to make money trading foreign exchange, and steps you can take to better understand yourself and improve your trading psychology and discipline.